I want to play this in recording so that others who are not here. Thank you. When you look at your screen, welcome to this program once again. So we are here to discuss financial reporting implication of limited liability partnerships, LLPs. Financial reporting implications, financial reporting implication of limited liability partnerships, LLP. In 2020, Nigeria enacted a new law titled Companies and Allied Matters Act 2020. That law replaced the SY Company and Allied Matters Act, Law of the Federation, 2004. So the 2004 edition itself was a revamp, an enlargement, and codification of all amendments to the previously existing CAMA 1990. Actually, it was the Companies and Allied Matters Decree 1990, and a whole lot of amendments had gone through between 1990 and 2004. So when the laws of the Federation of Nigeria were harmonized and consolidated, they were issued in a single volume, Law of the Federation 2004. So CAMA was one of the laws at the time that was consolidated in terms of the incremental amendments, and that it became CAMA 2004, Law of the Federation 2004. So a major overhaul was done to the company's law in Nigeria through the enactment of Company and Allied Matters Act 2020. So this act supersedes, repealed, legally speaking, repeals CAMA 2004 and becomes the substantive law concerning companies and business incorporation and governance in Nigeria. An interesting introduction under CAMA 2020, that is the Companies and Allied Matters Act 2020, is this introduction of the limited liability partnership. The limited liability partnership. Before now, we had the general partnership in Nigeria, generally governed by Partnership Act 1890, right, which was the statute of general application in Nigeria from the United Kingdom, way even before our independence. So we have that general partnership law called Partnership Act 1890. And also the Lagos State had their own version of limited partnership law, either 2007 or thereabout. And for the Western region, they also had certain partnership law. But with the enactment of Companies and Allied Matters Act 2020, it has made a provision for limited liability partnership, for limited partnership, in addition to the general partnership governed by the Partnership Act of 1890. So that is where we are currently in Nigeria with respect to partnership as a type of business. Our focus in this session is on limited liability partnership and how it has, and the impact it has, or the financial reporting implication, of limited liability partnership. So before we go into the financial reporting implication, it is important to get a quick overview of the nature of limited liability partnership. That is the essence of what I'm projecting on the screen, Part C of Companies and Allied Matters Act 2020. So there are provisions for limited liability partnership, as you can see here. There are also provision for limited partnership itself. Then before other form of businesses, so you have in Part F, the not-for-profit, the NGOs and their likes. Now, what is the meaning of a limited liability partnership? So we look at Section 746, Section 746 of CAMA 2020, subsection 1. It states that a limited liability partnership is a body corporate formed and incorporated under this act and is a legal entity separate from the partners, The form of partnership you've been used to, or most people have been used to, is the general partnership, where the partners are liable to any debt that the partnership business incurs or owes, apart from the asset owned by the partnership, meaning the law goes further to hold them personally responsible, severally and individually responsible, so collectively rather, and severally responsible for any debt or obligation that the partnership business is bound to fulfill or legally responsible for. So that is the concept of general partnership. But Camera 2020 has created a new form of partnership called limited liability partnership. It has always been there in Europe and in America, right? So these and we also used to have limited partner where only one partner's liability was limited. All of the partners, right, had their liability to be unlimited. But this introduction is a form of a form of introduction on partnership, creating a separate entity, that is a partnership itself, but is a legal entity, not just separate from the business entity concept or point of view, but a legal entity. Is a standalone entity recognized by law, and to own property in its name, to sue and be sued in its name as a partnership, not the individuals. So I take it again, a limited liability partnership is a body corporate formed and incorporated under this act, that is CAMA 2020, and is a legal entity separate from the partners. Subsection 2 of Section 740 states that a limited liability partnership shall have perpetual succession. Perpetual succession. Perpetual succession, it does not have an end to its lifespan. It does not have an end to his lifespan. When a natural person dies, when an individual dies, that person's life comes to an end, right? But unless a legal entity is wound up or liquidated, it continues to exist, right? So long as it remains a going concern, it is not wound up, it does not see separation, it does not die. So it has perpetual succession. So new partners can come in, partners can be changed, but the partnership remains. Section 747 states that an individual or body corporate may be a partner in a limited liability partnership, provided that an individual shall not be capable of becoming a partner of a limited liability partnership if he is A, of unsound mind and has been so found by court in Nigeria or elsewhere. B, an undischarged bankrupt. So this is the nature of limited partnership. In limited partnership, let's take note. Unlike the general partnership or other form of partnership, in limited liability partnership, so it's good to be emphatic. In limited liability partnership, the partners can be made up of individuals and or companies. Company A, Company B, and Company C, in addition to Mr. John, can be the partners in a limited liability partnership. So this is unusual compared to what you have in general partnership, where they have to be individuals. There have to be individuals who are the partners. Or even in limited partnership, there have to be partners, right? Some whose liabilities are not limited to what they have or invested in business, whose business liabilities, right, are not limited to what they've invested in business, but even beyond into their personal resources. But there must be one partner whose liabilities are limited to the amount of capital or money contributed for that business. That is limited partnership. So for limited partnership, there are individuals. For general partnership, there are individuals. But for limited liability partnerships, there could be individual, there could be body corporates or corporate bodies. So that is a striking difference between limited liability partnership, general partnership, and the limited partnership. The one you did in the university was the Common General Partnership governed under the Partnership Act 1890, which is a statute of general application in Nigeria, right? This is a statute that existed in UK, United Kingdom, right? Way before Nigeria came into existence, that we adopted, right? We adopted as a nation, and they continue to apply as a valid law in Nigeria, even after independence, or rather from independence to date, right? So call them statutes of general application. So they apply, generally in Nigeria. So in limited liability partnership, it could be made up of only individuals, that is fine. In addition, it could be made up of individuals and companies, if you want to use that word, companies or corporate bodies. So, but the key thing here, in addition, is that name, so and so limited liability partnership, is a legal entity. legal entity separate from the partners. You can't sue the partners, but you can sue the partnership. But in general partnership, right, and limited partnership, you can sue the partners involved. You can sue the partners because those other partnerships are not legal entity. They are not separate from their owners, from their founders, who are the partners. But in limited liability partnership, the partners are insulated, right, from personal responsibility, apart from when the vehicle has to be listed, though. But generally, it is the partnership that is the legal entity, and it is separate from the partners. So there could be individuals, there could be corporate bodies. So take note, this attribute of having corporate bodies being partners in a partnership is not found in general partnership or limited partnership. So I read paragraph 748, subsection 1. It states here, every limited liability partnership shall have at least 2 partners. Of course, for the formation of any partnership from a business, there must be 2 partners. There must be 2 partners, 2. That is the minimum number. So in this case, there could be an individual partner and a corporate body partner, 2 of them making up the 2 partners. Now, I want to quickly talk about someone or some people must be responsible for the running of a limited liability partnership business. They must be partners answerable under the law to compliance of the operation of that partnership to the provisions of Companies and Allied Matters Act. Yeah, there could be 40 partners, for example. There could be 50 partners, for example. But there must be people charged with the function of running the partnership. So when we used to hear about general partner, limited partner, nominal partner, quasi partner, and all of that. The general partner or the active partner, are those charged with the running, day-to-day running of the partnership, right? So in limited liability partnership, there are partners also who are charged, not just about running, because for every partnership, whether they are general partnership, limited partnership, or limited liability partnership, there must be partnership agreement. So there must be agreement, irrespective of the type of partnership. However, whatever your agreement stipulates, whatever that is contained in your agreement, the Companies and Allied Matters Act expect every partnership, every limited liability partnership business to carry out some compliance as stipulated in Part C of CAMA, that is the Companies and Allied Matters Act 2020. So it is an expectation, right, that a limited liability partnership complies with those things contained in CAMA. Then, of course, in addition to what may be contained in that partnership agreement. So the law has a need to hold specific persons responsible to operationalize, to activate, to effect the compliance requirements contained in CAMA for limited liability partnership. So certain partners have to be held responsible. So under CAMA, those partners are called designated partners. Those partners are called designated partners. So they are those responsible to ensure that an LLP complies with specific provisions under Part C of the Companies and Allied Matters Act. So if we say there must be 2 partners called designated partners, and these partners must be individuals. So what happens if Mr. A is a partner and ABC Limited is the second partner in a limited liability partnership? You recall, please note, when we say, under the law, for any limited liability partnership, the name of that partnership must end with the expression limited liability partnership. For example, A and B limited liability partnership. The law stipulates that the name must end in that form, just as it is required for a limited company, LTD or limited, or for a public limited liability company, PLC. So those expressions, right, must end the name of such entity. So it applies also to limited liability partnership. It must end with the expression or title limited liability partnership, or in short, LLP. or in short, LLP. Now, practically speaking, limited liability partnership is common. It's common in intellectual and professional services industry. When people come together, right, to run a kind of business that intends, right, to limit the liability or exposure of that business firm to what the business has, nothing beyond, nothing beyond, to limit the exposure, the liability, the obligation a business is responsible for to the resources owned and created by that business, not beyond, not crossing over into the personal resources, right, or personal finances of the partners. That is the concept of limited liability partnership. In addition, it is not a business that enables companies, bodies, institutions, right, to team up with fellow institutions or individuals to form a business that is in the form of a partnership firm that does not involve shareholding, equity distribution, allotment, and all those other governance complexities associated with limited liability company or company limited by guarantee and the rest of them. So that is the concept behind the need for a limited liability partnership. That was the concept. So before now, I was explaining the concept of designated partners. Partners charged and responsible, right, for complying with specified provisions under CAMA 2020 Part C concerning limited liability partnerships. So we call them designated partners. And we said those designated partners are required to be two, minimum two, right? So what happened when one of the partner is a corporate entity and the other partner is an individual? Or what happens when both partners are corporate bodies? So it is obvious that individuals are not involved, where both partners are corporate bodies. So the law mandates that each of the body corporate or corporate body must nominate, there must be a nominee, must nominate individuals who will serve as designated partners. So a nominee is someone representing a principal and carrying out responsibility as subsequently assigned under the contract, under the understanding, under the arrangement. So where there are two corporate bodies or three corporate bodies, or where all the partners in an LLP, right, are body corporates, they are all required to nominate an individual, right? Each of them nominate an individual to make available or to create or to enable the holding of certain person responsible for compliance of the provision of Part C for those roles specified or expectations specified for LLPs under CAMA 2020. That is what it is done. But where the individual partners are, of course, they are individuals, they are persons, right? Natural persons. Then just any two of them or more could be appointed or named as designated partners. So this is the structure. This is the background behind, behind limited liability partnership. And the law also stipulates that at all time, there must not be less than two persons or two parties. Two parties, because there can be individual person, there can be a body corporate. So at all time, there must be two persons at least who must be partners in a limited liability partnership. So when a partner dies, like an individual, a body corporate is liquidated or wound up, and probably before then, there have always been just two parties, the individual and the corporate, and one of them happens to die, where is the natural person, or the corporate body is wound up or liquidated, that leaves such LLP with only one partner. So the law stipulates that where such is the case, an LLP must ensure that the minimum number of partners required, which is two, is achieved within a 6-month period from the occurrence of that shortfall. Within a 6-month period from the occurrence of that shortfall. Failure to do that will be a violation for which whoever that keeps carrying on as a partner, as a one partner, and look at the irony, as a one partner LLP becomes responsible for or becomes liable to the penalties associated for not having showing up, using that word, in quotes, showing up the number of partners to be 2 at the minimum, right, in an LLP. So this is the structural foundation governing limited liability partnership. Then for financial reporting, what is the implication for financial reporting? Generally, the accounting function is the same for every kind of activity, for every kind of business, for every kind of business, for every kind of activity. The accounting process or processes are the same. But when it comes to reporting certain items concerning capital contribution, concerning equity, concerning seed funding, concerning resources, either owned by the founders or made available by parties outside of the business, there's a change in the structure. There's a change in structure. Therefore, if I go up to share an Excel sheet, for example, and we are saying, want to prepare or show or review statement of financial position. So let us say want to prepare or want to disclose the nature, a second please, a nature of statement of financial position. Now, if you recall, for a company, right, they deal for a company limited by shares, right? They deal with shares. We hear about the share capital. And just for us to remember, current in Nigeria from 2020, we no longer have anything called authorized share capital under the company law. We no longer have any capital called authorized share capital. That has ceased to exist under CAMA 2020. What we now have is called minimum issued share capital. Minimum issued share capital. So the company law does not want a situation where there's a certain number or amount of authorized capital and only a portion of it has been issued. So what the company law wants, that whatever share capital you have or you register must be the one that has been issued. So there's no longer a case of authorized share capital and then issue share capital. So that ceased to exist from 2021 up to date, right? So what we have, the nomenclature is minimum issued share capital. Minimum issued share capital. In other words, all the shares of the company stated or used in corporation must be the share capital which must be fully issued. So we call it minimum issued share capital. So we no longer have authorized share capital. What we have under our company law is minimum issued share capital. So back to what I was saying, for share-based company, we'll talk about the ordinary share, right? We'll talk about the preference share and the likes. But for a partnership business, recall, under general partnership, we talk about capital contribution, right? Capital contribution. And also whether a fixed capital system of a book of account should be maintained or a fluctuating capital system of book of account should be maintained. We remember, a fixed capital book of account system to maintain or a fluctuating capital book of account system to maintain. In a fixed capital, the amount contributed or introduced by partners are left intact, right? So any earnings by way of partnership salary, by way of allowances, by way of passages, by way of share of profit, by way of interest on capital, they are accumulated in another account called partners current account. So there's a partners capital account separate and frozen for the initial and capital contribution. And there's another account maintained for the partners, which we call partners current account. That is where we accumulate all earnings, all drawings, all entitlements, all resources, all incremental resources that are attributable or that are earned by each of the partner, different from the account that is frozen that contains the primary initial capital contribution made in the startup or in the startup of that partnership. That is the fixed capital accounting system. In the fluctuating capital accounting system, we do not differentiate both the capital introduced, interest on capital, drawings, interest on drawing or charges on drawing, salary, allowances, passages, share of profit or share of loss, share of profit or share of loss. All of these are posted into a partner's capital account. And what happened? The balance keeps changing for each of the partners. The balance keeps changing. So that one we say is a fluctuating capital accounting system. Fluctuating capital accounting system. Then the other one is a fixed capital accounting system. Now, back to this. So limited liability partnership. We are talking about individuals, we're talking about companies whose liabilities are limited, right? Their liabilities are limited to what they brought into that partnership business and not beyond. So the question is, when you prepare, let us say, statement of financial position, for example, when you prepare a statement, a second please, when you prepare a statement of financial position, one place of our brand position. Now, the place where we have all these shares and all of that, what appears there for a limited liability partnership? So let me call this statement of financial position, right? Typically, now want to come to, yes, okay, so that's fine now. Maybe let me make it bolder. Let me make it bolder. It's hanging. I don't know what is hanging, but okay. So what we want to do, we want to show how the capital structure, the line item associated with capital structure, want to show or reflect how they appear. You are not going to have minimum share capital because no shares are involved, right? Now, you are going to have, of course, capital, the capital account. There's going to be a capital account, which we are going to call, partnership capital account. Partnership capital account. A second, please. Okay, I think it's fine now. So let me make this 14. So we're going to have, so let's say this is the state of financial position, for example, and then we are now trying to arrange it. Let's say we're starting from the capital part, right? For other form of businesses, for companies, we say, typically we say share capital. Right? Your share capital, right? So under the general heading, equity. Under the general heading, equity, that what we call it generally. Then we say there's a share capital. The part of the share capital, that could be something like retained earnings, right? That could be something like share premium, right? That's only like share premium. Then that could be something like revaluation, surplus reserve, another kind of reserve. So this is typically some of the components that we'll see under the equity part, right? Under the equity part or under the equity sub of a typical share-based company. These are the items that we see. Now for a partner, for a limited liability partnership, now we can't use the word share capital. We can't use the word share capital. So what do we use? Please note, in the statement of financial position. Now, because the business, take note, because the business is separate from the partners, is a legal entity, unlike the partnership you are used to, unlike the general partnership and the limited partnership, where any profit, you do share of profit. When you do share of profit, you credit the partner's capital account and debit your profit or loss appropriation, for example, right? Where is a loss, you debit the capital account and credit the profit or loss appropriation, right? It may be a case of partner's current account, the same thing, where you are doing a fixed capital account system. In a fixed capital account system, the capital account for the partners remain the same. This is what I'm saying. Let us say for a partner, you are going to do like capital, right? The under capital, you're going to have Mr. A, maybe 22,000. Then Mr. B, maybe 5,000, right? Now, in a fixed capital accounting system, you are going to have a current account, partners current account, right? Partners current account. So here, you also have for Mr. A and also have for Mr. B. Now, the essence of this is the summary. For any profit or loss made in a period, it is shared. Any loss is shared and credited or debited, credited or debited to their profit account, whether the capital account in a fluctuating capital accounting system or whether the partner's current account in a fixed capital accounting system. That's what it is done. So in partnership, whether general partnership or limited liability partnership, there are no reserves. No reserves. No reserves. Unless in rare situation where the partnership agreement stipulates that certain amount should be set aside as a reserve, right? As an exigency fund, as an exigency resources for future engagements or eventualities, except that. But ordinarily, all profits or losses are shared and are credited or debited accordingly to the respective partners' accounts, either capital or current, as the case may be. But for a limited liability partnership, no. So this is the way it appears. For a limited liability partnership, now the heading of course won't be equity, right? Won't be equity. Won't be equity. We can just call them, just capital. Just capital. That'll be fine, right? Capital. So if you go to IS1, it permits you to use description, right, that convey the same meaning as equity when the entity involved is not a share-based entity. We can just say capital, right? Now, for this, we don't say Mr. A and Mr. B. All the amount, So here we can just say we can just say here is let's say yes, we can just say capital resources, right? That will be the heading. Down here, you have the capital contribution. Capital contribution or just capital if you want. Now, for a limited liability partnership, there will be retained earnings, right? Because maybe not all the profits that have been made, right? Maybe not all the profit that will be made will be shared and allocated, right? So there could be retained earnings. For a limited liability partnership, there could be retained earnings or reserves. Of course, there won't be a share premium. There won't be a share premium. So this has to go. There won't be a share premium. Why? Because the entity is not that it will share. Of course, there could be a revaluation surplus reserve, depending on whether certain assets, especially relevant items of property, plant, and equipment like land and building, right, are revalued. So now for this, we don't come and write. If we don't write here in the capital account, we write capital, we'll not write partner A, partner B, partner C. No, not at all. So it's going to be capital 1, then there'll be retained earnings or reserve, because not all earnings will be distributed. Not all earnings will be shared. And even when they are shared, right, they go into the capital account. They go into the capital account. So let's take note. So maybe if I have to delete here, so in a typical limited liability partnership kind of business, right, the entity is different. So note, in the example I contrasted here, under general partnership and limited partnership, the individuals are not separate from the business legally. They are not separate. They are the same. So they are identified individually for the purpose of reporting. But for this, under limited liability partnership, the partners are, so let me delete this. The partners are different. The business is a legal entity, separate and different from the partners. So in that case, what do we do here? This is Angel. What do we do here? So nothing like writing capital, Mr. A, partner one, ABC Limited, body corporate, XYZ Limited, body corporate, Mrs. D, another partner. No, because the business is separate from the owners. The business is separate, legally separate, not just nominally, not just by the business entity concept. It is separate from the owners. So this is how we present the capital information concerning partners in a limited partnership. That is how we present it. So take note, capital, not the type where I wrote under capital, I then did Mr. A, Mr. B, Mr. C, partners current account. So also, in limited liability partnership, there's not like partners current account. So if they are borrowing or advances to any of the partner, it will be captured accordingly as advances to whoever it has been given to. Not in form of partner's current account. No, there's no moving account reflecting all of this. Why? Because they are separate from the business. So any advance or borrowing or whatever has to be captured separately, not in form of a revolving partner's current account where profit, losses, drawing interest are recorded. No, not at all. Not at all. So in summary, we're going to have the capital, which is for the capital contributed by all the partners. We're going to have retained earning, which is accumulation. We're going to have them any other reserve that ordinarily exists. That's what we're saying. We're going to have any other reserve that ordinarily exists. That's the nature. Please contrast it with a general partnership and limited liability partnership. So it won't appear this way. No, it's going to appear this way. Just the capital, right? Or capital resources or capital fund. They're made up of capital without no name attached. Then there could be retained earnings which may not be found in general or limited partnership because every profit or loss, profit or loss is shared and entered into the appropriate partner's account. So that's what we should take note. So that is the implication in the statement of financial position. Now, let's move on. From there, let's go to the statement of comprehensive income. Let's go to the statement of comprehensive income. Income for the year ended in that way, right? So let's say this is a statement of comprehensive income. So revenue will remain revenue. All of those line items will remain the same until you get to profit for the year. Until you get to profit for the year. Recall, the profit for the year is going to, so in other words, nothing changes here apart from introduction of any allowances or payments agreed under the limited liability partnership to be due to any of the partners. Right? Nothing changes. Now, but any payments, any entitlement due to those partners will not be reflected here. So the only thing that will reflect here are like passages, entitlement, maybe one of the partners incurred expenses for a business trip and not to be reimbursed. So that reimbursement does not mean the payment to the partner. It's just a reimbursement. So that is a business traveling or accommodation expenses that are going to come within here. But something in form of profit, gain, entitlements, and all of those things concerning any of the partner as a partner, not concerning the routine running of the business or operation. All such movements movements as expense or income for the partners concerned are recorded in the statement of changes in equity. They are recorded in the statement of changes in equity. Let's take note. They are recorded in the state of changes in equity. But for a partner, we can't use the word equity. It does not suit. We can just write statement of changes in capital. Statement of changes in capital, that is fine. Statement of changes in capital, we can also say statement of changes in net assets. So let's take note. And that made me remember, under general partnership and limited partnership in IFRS, where you used to do your appropriation entry, your appropriation, share of profit, share of loss, interest on this, interest on that. Those transactions between the entity and its partners are reported within statement of changes in capital, or what you call statement of changes in equity. That is why they are reflected. So we don't create an appropriation section under statement of comprehensive income in IFRS. We don't. We don't. It stops at profit for the year, and maybe you have other comprehensive income for the year. Then the addition of the profit or loss of the year and other comprehensive income for the year will give you the comprehensive income for the year, right? So anything like partner's salary, interest on drawing, interest on capital, charges on drawing, all of those things, share of profit or loss, they are reflected in statement of changes in equity, which is the general name common for companies, or simply statement of changes in net assets, or statement of changes in capital. So that is what that means. So back to what we are here. So when we say let's copy this, let's just do a fast copy and paste, right? So if we do, so let's change it to statement of changes in capital, yes, or slash net assets for the year ended. That's what it is called. That's what it's called. Please here, unlike the general partnership or the limited partnership, go and write Mr. A. Here, Mr. B. Total. No, we don't do that here. We don't do that. We don't do that. This is a no-no. Let me put it in red. This is a no-no. In fact, let me put it in red. We don't do that at all. Not allowed in any form. So don't do this. Is not allowed at all. It stays with the reason. It stays with the reason. Let me just insert a comment. Not allowed in limited liability partnership. Not allowed. Now the reason. Okay, yeah, not allowed. Now, what is the reason? We maintain the same principle. The individuals are different from the business. No, when you write this, just inside the heading of the capital or net asset component, which is capital itself, right? Capital itself, then retained earnings, right? Maybe retained earnings is not complete. Let me maintain what was there before. Let me take this away. So I'm taking them away. Capital followed by retained earnings. Retained earnings. Then followed by let's assume they have one of those reserves, right? Let's say they have I've opened this too widely. Let's say they have just reserves as a name. Reserves as a name, right? Then this is for the total. This is for the total. So this is the heading for statement of changes in equity. We may just put this there and we're fine. So that's how it is done. Return earnings, capital E, yes. So this is how it is done. Yes, this is how it is done for an LLP. This is how it is done. So if you watch, there is no Mr. A, Mr. B, Mr. C, as is done in other ordinary partnership. Let's take note. All of them, Mr. A, Mr. B, no, because they are different from the entity. The entity is different. So that is, these are the important implications. All other accounting processes remain the same. So if you resume somewhere tomorrow as the head of account for a law firm that's an LLP, right? For a firm of Austin Surveyor that's an LLP, for a special purpose vehicle, SPV, of individuals and companies that is an LLP, or for professional services firm that's an LLP, when you prepare the account, take note of these items, right? The way the capital structure and information is presented in the statement of financial position, as we did when we started here, yes, as we did here when we started. And also, we highlighted that nothing like this appears because the individuals are different from the business and that this is not a general partnership or a limited partnership. We said for the income statement does not have comprehensive income, everything remains the same. The only thing you may see may be expenditure incurred by each or any of the partner on behalf of the business. So it's going to come in here accordingly on behalf of the business, not for their personal self or entity as partners. So we then move on to emphasize that for the purpose of state of changes in equity, which we call state of changes in capital or state of changes in net assets, so all the payment of salary, withdrawal, payment of problem of entitlement, share of profit, and all of that, this is where you reflect it for any kind of partnership generally. But for LLP in particular, we don't personalize, we don't individualize, right? Because the entity is different from the partner. So we don't write capital, retained earnings, other reserves, because retained earnings is a kind of reserve, right? Other reserve, then the total. So these are the area of differences in financial reporting for limited liability partnership. Take note of the capital structure information, of financial position. The expenses remain the same and income remain the same instead of comprehensive income. Apart from expenses incurred by partners on behalf or in the routine operation of the business that has been reported there, and that any withdrawal, transaction, or profit, and all of that concerning the partner, any share or flow of resources in or out between business and the partners that are not about the business themselves are recorded or reported or presented in the state of changes in capital or in the state of changes in net assets, and that we don't personalize, we don't individualize, we don't name the party or the partner concerned in trying to break up the allocation of capital or retained earnings. No, because the entity is different from the partners and they stand alone. So that is the core of the implication of LLPs in financial reporting based on CAMA. So thank you all for joining us. Thank you for thank you for your patience. Thank you for patience. Thank you for patience because the network was doing all manner of stuff, but we're happy we're able to come, get back on and do a 1 hour. Thank you for every single thing. So please, on your own, download the Companies and Allied Matters Act 2020, go to Part C and read up from section 748. Read up to the end. You see everything about limited liability partnership. But we focus on the financial reporting implication. There's another section, another Part D, dealing with limited partnership. And in that order, right? Limited partnership. Nothing differs per se, right, from the general partnership, except that the liability of their partner, limited partner, is limited to the capital contributed or undertaking to be contributed and nothing more. But for other partners, the liability obligation of the business proceeds further down their personal resources if the resource of the partnership business cannot clear, right, or pay off any such obligation. But for limited liability partnership, it is limited squarely to the resources owned by the business. But for the compliance of the operation of the business with CAMA, there must be partners, minimum 2, who are called designated partners that must be responsible for complying with the provision of CAMA, right? Complying, they're going to be held personally responsible for complying with the provision of CAMA concerning the limited liability partnership, and also maybe other content contained in the LLP partnership, in the LLP agreement, as the case may be. So that is all for this set. Thank you for joining us. Any question or commentary as we sign off? Any question, commentary as we sign off, please? Any question or commentary as we sign off? Okay, if there are no questions, thank you so much. Now, just to inform us, our session, because of the nature of the business of Saturday, is going to hold every Friday. Every Friday. So for the next session, it's going to be Friday. We're going to do it 6 to 7, please. 6 to 7 on Friday. So we're all back from school, we're all back from study, we're all back from our NYC camp, we are back from work and all of that. 6 to 7 Friday, 6 to 7 Friday. Let's get in cracking. Thank you, Alagbe Ayobola. Thank you, Hope. Thank you, Abdulrazak Abidemi, Oluyinka Paul, Obodo Solomon, and the rest of you. Thank you so much. Let me check. Is there a chat saying anything? Let's just check the chat. I think, those are commendations. Those are commendations. Okay, thank you so much. Bye for now. Enjoy the rest of the weekend. Bye.